Today we're diving into Lindt & Sprüngli, the premium chocolate powerhouse. We'll cover the business, the numbers, the competitive moat, the strategy, and what the ownership structure tells us. This video is for education only and not financial advice. Always do your own research and consider your risk profile. Investors love Lindt for three reasons: premium branding, pricing power, and a long record of compounding. It's often seen as a quality defensive in consumer staples. Lindt has a special structure: registered shares with voting rights, and participation certificates without voting rights. Most investors focus on the participation certificate. It gives economic exposure but no vote. Lindt is a Swiss premium chocolate leader with global distribution, plus its own branded retail footprint. The core is Lindt, with hero franchises like Lindor and Excellence. Lindt is positioned as premium and giftable, especially during seasonal peaks. Even in tougher economies, affordable luxury can stay resilient. The model combines retail partners with direct channels. Direct-to-consumer is strategically important. It reinforces the brand and can improve margin mix over time. The Lindt engine is a loop. Brand strength enables pricing power supports strong margins, margins fund reinvestment, and that reinforces the brand again. Revenue has shown consistent long-term growth, with a temporary pandemic dip. The post-pandemic period has been driven strongly by pricing and mix, not just units. As an anchor, 2024 delivered sales of roughly 5.5 billion Swiss francs with high single-digit organic growth, and operating margins improving into the mid-teens. Margins are a central part of the Lindt story. Premium positioning supports high gross margins, but cocoa volatility can squeeze profitability, so price actions and cost discipline are critical. The key drivers are the classic Lindt playbook: price and mix upgrades, strong seasonal execution, consistent brand investment, and operational efficiency. In inflationary periods, the industry often sees volume pressure. Lindt's goal is to protect brand integrity while passing through costs. The risk is consumer trade down. That's a key metric to watch. Comparing Lindt to mass-market candy giants can mislead. Lindt's profitability is shaped by premium quality control and brand positioning, designed to support pricing power over time. As volumes grow, Lindt can benefit from operating leverage. Efficiency programs and capacity investments help protect margins and prepare for future growth. If we summarize, growth has been strong, margins resilient, brand elite, cash generation strong, and the recurring threat is cocoa cost inflation. Lindt tends to operate with a conservative balance sheet, keeping flexibility. That matters because the company wants to invest through cycles and still return cash to shareholders. For a consumer staples compounder, cash flow is the truth. Strong operating cash flow funds CapEx, and free cash flow supports dividends and sometimes buybacks. The capital allocation playbook is simple: protect the brand, invest in capacity and productivity, pay a growing dividend, and run buybacks when the balance sheet allows. Lindt is not a high-yield stock. The yield is often modest because the share price is high. The appeal is consistent dividend growth and stability. When Lindt runs buybacks, it can be a signal of confidence and improves per-share metrics. Still, dividends remain the primary shareholder return channel. Lindt behaves like a quality defensive over time, often with lower volatility than the broad market, but it can still move sharply when cocoa costs dominate headlines. Lindt often looks expensive on traditional multiples. The market pays for brand strength and resilience. But remember, a great business is not automatically a great price. When analyzing valuation, keep it simple. P/E for quality premium, EV-based multiples for operating earnings, free cash flow yield for reality, and dividend yield as a secondary signal. High multiples can be justified if Lindt protects pricing power, maintains volumes, keeps margins resilient through cocoa spikes, and continues to grow steadily above the market. Valuation can compress if cocoa inflation remains intense while demand weakens, if consumers trade down, if margins disappoint, or if the whole market reprices quality stocks lower. Lindt is a compounding story, but entry price still matters. Many investors handle this by keeping it on a watch list and waiting for moments when sentiment swings too negative. Instead of obsessing over precise fair value, track 4 practical indicators: organic growth, operating margin trend, price versus volume balance, and management's cocoa outlook plus price actions. The market has 3 layers: mass market giants with scale, premium competitors with brand storytelling, and local artisan brands with authenticity. Lindt competes primarily in premium. Lindt's moat rests on 4 pillars: global brand equity, pricing power, a strong distribution and direct footprint, and world-class execution around seasonal gifting moments. In tougher times, consumers may buy fewer items, but treat spending can remain. Premium winners can even take share if others rely on discounting and dilute their brand. To test the moat, ask: can Lindt raise prices without losing volume? Does brand strength continue to grow with marketing spend? And can margins hold up through cocoa cycles? Lindt's strategy is premium-led growth. Protect positioning, invest in the brand, innovate carefully, and expand direct-to-consumer channels and priority markets. Growth comes from pricing and mix, selective geographic expansion, retail and e-commerce scaling, and capacity plus productivity investments. If you boil it down, Lindt's advantage is simple: a premium brand that can raise prices without breaking demand, supported by quality consistency, seasonal mastery, and direct brand experience. One important detail: participation certificates don't carry voting rights. Governance is stable because voting power sits elsewhere, but participation investors should understand their influence is limited. The top risks are cocoa volatility, demand elasticity if price rises go too far, and any brand dilution or execution mistakes, especially around seasonal peaks. Final takeaway: Lindt is a great business, often priced like one. Keep it watchlist worthy. Track organic growth with price versus volume balance, operating margin trend, pricing commentary, cocoa mitigation, and progress in direct channels. If these stay strong, the quality thesis remains intact.